Thanks again for coming out. My name is Sean Moore. I'm the owner and the founder of Smart College Funding, and we do a lot of work in conjunction with Milestone and other college advisors. And I really, really like Milestone. I think what they do, Jen and I we kind of hit it off when we first met each other, because we both have a very similar viewpoint on putting clients first and doing the right thing for families. And so tonight, these are virtual reality goggles. I'm going to have everybody don their virtual reality goggles, and you're going to dive into my world tonight, which is the world of financial aid and beyond. But first, can everybody hear me okay? Am I shouting at anybody? First, I'll tell you a little bit about who I am. I told you my name, Sean Moore. My background is a financial advisor. I'm a certified financial planner, chartered financial consultant. I've been doing it for about 18 years. And about 7 years ago now, my oldest daughter was born. And at the same time, I was looking at saving for colleges and how I'm going to pay for my daughter's college 18 years from now. I had clients that were coming to me, and they were now in their 40s and late 40s and 50s, and their children they'd been saving, but their children were now getting to college age, and this business was kind of born out of that. So the first half of my career, I was actually doing retirement planning. The problem is, as we all think about this road to retirement, there's a toll booth that all of us are going to have to go through, and that toll booth is paying for our children's colleges. So that's how this business was born. It's been about 7.5 years now. It's been kind of my core focus, and I'm the father of 2 young daughters, as you can see there. They're very adorable. The oldest one, Olivia, looks very different now. She's kind of at that phase where she smiles. She looks like a hockey player from the 80s. And my wife does all the heavy lifting, as you can see. I'm also a Florida prepaid beneficiary. We're not going to talk about prepaid really much tonight, but it's a resource that a lot of you guys have. And I had Florida prepaid myself. I have not always been a fan. When my oldest daughter was born, I didn't like it because the prices had gotten out of control. And then when 2014 came around, they changed the pricing structure, and I spoke out positively on their behalf. And now they actually hire me to go around the state and speak to other financial advisors about the plans, how it fits, how it works. So I don't want to toot my own horn, but I know a lot about it, more so than most people, because I've used it myself as a parent, I've used it myself as a student. I advise other advisors on it. So if you have any questions on how it works, and we'll touch on that later in the presentation, but it's something that we have in Florida. There's only a handful of other states that have a prepaid plan, and we have by far the most cost-effective one. So it's not your imagination. College costs have run away. I mean, it's not just it seems like it's so much more expensive. This is a chart, a graph. Everybody knows that of the inflation of different purchase items that we have over the last. This is over the last 40 years, but I've actually got data going back 100 years, and while medical expenses have gone up, and they've gotten far more expensive, and that's topic of conversation among doctors or among people in election cycles. People want to talk about health insurance and all that stuff. The reality is medical costs pale in comparison to the rise we've seen in the cost of tuition. So it's funny. Does anybody know what a stamp costs today? Good job. 50 cents. It's funny because we used to buy stamps, right, for 40 cents or something, and then they raised the price, and you had to buy those 1 cent stamps. So that doesn't happen anymore. Everything's forever stamps. They don't have dollar figures on it. But a stamp 100 years ago, in 1918, cost 3 cents, and today it costs 50 cents. I mean, inflation is a reality of life. But here's how it plays out in the college world. Tuition at Harvard, these numbers are now from 1915 to 2015, but tuition at Harvard was $150. If it had the same inflation that stamps had, or gasoline, or most things that we're used to, tuition at Harvard in 2015, not even today, tuition in 2015 would have been $3,544. Instead, in 2015, it was $45,000. Colgate's got NYU, has a bigger spread. They were $125, and they're now $47. Colgate was only $60, they're up to $50. Stanford was free. And it's now going to run, today it's going to run about $50,000 a year. And this isn't tuition. We're going to talk about the costs of college. Costs are far beyond tuition. But it blows my mind when I look at the numbers and how dramatic it has outpaced what's normal for inflation purposes. So we're going to dive into my world, financial aid and beyond. And tonight we're going to deal with paying for college in 2018. Unfortunately, we don't get those 1915 prices. So we'll dive in. We've designed what's called the Smart Core 4, and again, kind of with my background as a CFP, everything I want to do is holistic. So I want to take the long view and have kind of a holistic nature in how we approach things. And so my belief is that a well-rounded college plan has 4 components to it. And the four components are college selection, financial aid, personal resources, and tax aid. Financial aid, we call it money, so it works out to be SMRT. But for tonight, we're changing it to financial aid. Talk about college selection for a second. I'm not going to spend too much time on this because this is where Milestone comes into play. They're a phenomenal group for finding the right colleges for the right reasons. But there's three components to it. You get your admissibility, your fit, and your price. And I call these the head, the heart, and the hand. Right? The admissibility is your head. That's can you get in? How likely are you to get in? Is this a likely school? Is it a target school? Is it a reach school? Because first of all, we don't want to set our students up for failure. Right? We don't want to give them unrealistic expectations. And the likelihood of you getting into a certain school has a very big impact on how much you might end up paying for that school. Now that's not always the case. You know, the Ivy Leagues, that is not really the case. It doesn't matter. If you get in, and you pay what you're told to pay. But in most schools, your admissibility can then impact your overall costs at the university. Fit is so important, and I'm afraid a lot of students look at it backward, right? FSU wins the national championship, not this year, but school wins the national championship, and that's where they want to go. They choose their school, and then they find a major at that school, and then when they get out, they try and find a job in that major. And that's a backward way of going about it. What I want, and why I love this program that Milestone does through Youth Science, is it helps children find their students, not children. It helps students find their strengths, who they are as a person, and then they can find out a career. From a career, they can find a major, drilling. That's where Milestone uses it, drilling in a major. And then from the major, you find a school with that major. Because one of the things we'll talk about in a second is how long it takes students to graduate. But a big part of that is if the school's not the right fit. It has to be a fit, from a geographical standpoint, from a financial standpoint. But it really makes a lot of sense to have the student not changing gears halfway through their sophomore year and then having to scramble at that time. And the last part is price, because we just talked about college is expensive, and we want to have, hopefully, the smallest impact that we can have when we're paying for college. So what is the cost, right? What's the cost of college? These are the numbers from, the most recent numbers we have through IPEDS, which is the National Government's tracking system for college costs. But I talked about tuition a few minutes ago, and the reality is the cost of college is based on what's called COA, cost of attendance. And cost of attendance is tuition, fees, books, room, board, medical expenses, health insurance, everything, the whole ball of wax. And these are the national averages. Ours are relatively close. So a two-year school like your Palm Beach State is about $17,000 a year. A public four-year in-state, so your UF, Florida State, UCF, is averaging about $25,000 a year for 4 years. No, I would say take it back, $25,000 per year. We'll just leave it at that. And then your out-of-state, same student going out-of-state, so your UGA or Tennessee or what have you, is going to pay about $40,000 a year. And then your private school, averaging around $50,000. I'll tell you, we're a little lower than the average, where our cost in Florida for a state school is around $21,000, but this $50,000 is way, way, way low, in my opinion, for a lot of schools we're staying. I mean, heck, right next door almost, Lynn is almost $60,000. Miami's in the high 60s. When you're at the Ivies and stuff, you're knocking on the door of $70,000 per year. So it's a real number, and it's a real large number. So I mentioned something when I was talking about fit, but time can have a big implication on cost. And sometimes the cheaper school's not always a less expensive school, if that makes sense. So University of Florida might be $21,000 a year, and Duke, big spread there, but Duke might be $40,000 per year. But the average student at a public university, only a third of them graduate on time. Whereas the private universities, more than half do. And if we're looking at I shouldn't pick on UF because it's a phenomenal school, but if you're looking at Florida Gulf Coast versus Duke, the graduation at Florida Gulf Coast rates are horrible. And you compare it to a school like Duke, where 80% of students graduate in 4 years and 90 plus graduate in 6 years. If you have to pay less money, but you're drawing it out for 6 or 7 years, it can have a big impact on your total overall output. So it's something to pay attention to, is what are the graduation rates of these schools, how many freshmen are coming back, and how many people are transferring out as well. All right, tonight we're here to talk about financial aid, right? So we'll go ahead and dive into financial aid. There's two types. We're here in Boca Raton. There's people of all income ranges here. I don't care how much money you make or what your net worth is, you are never too wealthy to qualify for financial aid. All right? And a lot of people have this mindset, though, we make too much, we live in too nice of a neighborhood, yada, yada, yada. There's two types of financial aid. There's need-based aid, and there's merit-based aid. And merit-based aid is it's based on your ability to play. And play could be sports, it could be academics, it could be what have you. And then there's need-based aid, which is based on your ability to pay. So there's two different types, and it's important to know the difference and where you fall on the spectrum. This is important to note. Parents and students are now sharing, again, this is averages, but they're sharing the burden for paying for colleges. And this is again from the federal government. 2017, last year, the scholarships and grants were the largest share that they've been in over a decade, which is really good news. I mean, students are picking up part of the tab, whether they realize it or not, because they got scholarships or they get grants, they worked hard. What they don't tell you in this slide is if you look over here, the two yellow bars, that's borrowing. That's student borrowing and parent borrowing. And so even though grants and scholarships are up, so is borrowing. So the costs are going up, and schools are sometimes being more generous, but a lot of times it's if you get a discount on this side but you're paying more on this side, it's kind of a wash in the end. So it's important to look at, and we'll get into the details of how schools meet need or how schools dole out their financial aid. But the important thing to remember is there's two types, merit and need-based. How do you get merit-based aid? Be a good student. It's the number one thing you can do. Get good grades, build a great resume. Again, this is where your team at Milestone comes in. Build a great resume, have a great application essay, and invest in SAT and ACT prep. It's especially here in Florida. So generally speaking, merit-based aid is doled out by the schools, but not always. And I think I have this in a later slide. Here in Florida, we have merit-based aid doled out by the state. Is everybody aware of that? It's a Florida Bright Futures program. And most students I see that are close to getting a Bright Future scholarship, they have the community service hours. They usually have the GPA. The thing holding them back is their test scores. And it could be money well spent. If you spend, I don't even want to quote numbers because I don't know what the prices are. But if you spend a few dollars here for test prep and it gets you those 2 points you need, and it results in a Bright Future scholarship, I mean, it could be a 10-to-1, 20-to-1 return on your investment. So things to think about. The student's responsibility is heavily, or the student is heavily responsible for the merit-based aid. And it's just painting the best picture of your student and presenting their best side. Need-based aid is where we get into what I call the alphabet soup of college planning. And there's a bunch of acronyms up there. We got FAFSA and CSS and COA and ESC, and we'll get into all those. But this is a fun jargon part of the presentation. So you can't start financial aid without F. And F is for FAFSA. We're going to get into the who, what, why, where. What are we going to get into? Who, what, when, where, and why of FAFSA. So who files it? Parents of high school seniors. File it for the first time. I should have done this at the beginning. Quick show of hands. How many people here have high school seniors in the room? Vast majority. Okay. Juniors? Sophomores? Freshmen? Some of you guys already have someone in school. But high school parents of high school seniors will fill it out for the first time. The parents should fill it out. The reality is when you do FAFSA, you'll realize that it actually says you. When FAFSA says you, it's speaking to the student, as if the student would know the parents' income, income for last year and taxes for last year and whatnot. The parents should be the ones doing this, but it does speak to the student. And then it's done every year thereafter. It's not a one-time thing. It actually has to be done each and every year. So those of you guys with students in school already know that. What is it? It's FAFSA. It's a free application for federal student aid. It's free. There's no cost to complete it. And it doesn't mean you shouldn't pay somebody. There's a lot of families that don't feel comfortable doing it, or they have certain circumstances what have you, and they want a professional to do it for them. That's fine, but the actual filing of the FAFSA itself should always be free. We'll talk about that in a second here. There's, if you just Google, you can get tripped up. So do understand it's free. It's administered by the Department of Education, and it's used by all schools. I know it says almost all schools up there, but there's a nuance in there. It's used by almost all schools to distribute both federal and institutional need. We'll get into that in just a second. So when? October 1st. We're lucky this year because October 1st is a Monday. So that's going to be a busy week for me, and I'm sure it will be a Milestone as well. October 1st is when the FAFSA window opens, and you want to file as soon as you can. It doesn't have to be October 1st. But you don't want to sit on it. You don't want to file this thing in January or February or March or something like that. Sooner is better because there are deadlines. And there's money out there that's first come, first served. So once they've doled it all out, and you can put your application in, you might have qualified for that money, but once it's gone, it's gone. So you want to plan on getting it done sooner rather than later. And the October 1 filing this year will then be for everybody either matriculating or continuing college next year. Where? FAFSA.ed.gov. It has to be a government website because, again, I think there's a FAFSA.com. There's a couple FAFSA-related websites out there. If you just type it in Google, then they'll trip you up and they'll cost you a few dollars. Then you've entered a bunch of personal information in there and stuff. So make sure you're using the federal government's website. And they actually, I think they're back up and running. They were going through an update, and it actually looks, FAFSA was just terribly, terribly out of date with their look and stuff. And they've refreshed their website this year, so it looks a little more up to date. And then why? Really, this comes back to another acronym. We do it to get our EFC. So our FAFSA will give us our EFC. And it can actually, that EFC will then be disseminated to up to 10 schools. And it's going to be the same for every school as determined by FAFSA. If you have 15 schools you're applying to, which I've got students that are doing that, we file FAFSA. Just for argument's sake, we file it on October 1st. It takes 2 business days to get sent out, emailed out to each of the schools. Once we've got confirmation, then you go in and you can delete those 10 schools and add 5 more, or 10 more, however many you want. But it'll take up to 10 at a time, and there's a workaround there if you need more schools to be sent that sent to. So we're done, right? FAFSA and done. I've got an and sign up there, and so we're going to get into the and, which is a CSS profile form. I talked earlier, there's 2 different types of financial aid. There's need-based and merit-based. In the need-based world, there's also 2 different methodologies. There's a federal methodology, which uses FAFSA, and there's its institutional methodology, which uses a CSS profile. And the CSS profile is done by the College Board. Same people that take the SAT test through, same people that do the AP courses. And it's used for your mostly private schools. The more selective schools are all going to use your profile form. And then the really high-end name brand public schools. So your University of Michigan, Virginia, Georgia Tech, Chapel Hill will be your state schools that will also use the CSS profile and using the institutional methodology. The one thing to know is if you're filing if you're filing a profile, you need to know the deadline. See, FAFSA has 2 deadlines, technically. There's a federal deadline for FAFSA and there's a state deadline for FAFSA. With profile, every school sets their own deadline. So again, it makes sense to just get it done earlier. Don't leave it, 2 or 3 months out because all of a sudden you could be missing one school's deadline and not another school's deadline. So it's something to pay attention to when you're filing the profile form. The profile form, as I mentioned this, I think already, is that it's in addition to FAFSA. So if you have a school that's a profile school, you don't file profile instead of FAFSA, you file it in addition to FAFSA, which is why I have this in the and category. It digs deeper, and it costs money. So FAFSA, again, is free. Profile is $16 per school. There's a $9 filing fee. So it's $25 for the first school and then $16 for each additional school. Good news, bad news. People in North and South Carolina probably aren't going to pay this fee this year. We didn't pay it last year. Everybody that I helped last year, not everybody, almost everybody that I helped last year, we got waivers because we are in a disaster area because of Irma. So unfortunately, those guys, keep them in your thoughts, but they're going to get out of $16 per school when they file their CSS profile. How is it different? When you file your FAFSA, your EFC is calculated by the Department of Education, and that EFC is sent out to every school. And the federal government sets your EFC, your expected family contribution. With the profile, the schools will determine whether or not they like that EFC or they want to calculate their own EFC. So your EFC can be different. They ask more details. And I'll get into this in a few minutes, but they ask about things the FAFSA doesn't ask about, like how much is your home loan? How much do you owe on it? Do you have any businesses? What are your businesses worth? And then they also want 3 years of data. So FAFSA just looks at a single year in time, a single snapshot in time is 1 year. CSS profile will look at that same window, but they want to know about the following year and then the year after that, which is crazy. So you're filing in 2018 and they're asking for your 2017 numbers, but then they want to know your 2018 numbers, which by the time October rolls around, even people that are on commission or have fluctuating incomes usually have a pretty good idea what they're going to make. But then they want to know what your 2019 income's going to be. A lot of us don't have any idea what that's going to be like. And they may ask about non-custodial parents, so we'll dig into that a little bit later. I think I said this once or twice now, but FAFSA is not in lieu of profile. It's in addition to. So everybody, every school has to use, or every school does use the FAFSA form. And then many schools will use the profile in addition to. So it's FAFSA is a must, profile is a plus. All right, the acronym I mentioned a couple times so far is EFC. What is it? It's expected family contribution. This is how much is determined that you will be able to pay before you get any need-based financial aid. There's 4 different components of it. You got parental income, parental assets, student income, and student assets. Parent income is based on what's called your base year, and that changed about 2 years ago. What a base year actually is, made things easier but slightly more confusing. So what is a base year? The base year is the snapshot I talked about that they look at for your income, and it's called prior year, which means they're looking 2 tax years back. But when they change the prior year, they change the filing from January to October. So prior is prior from the year that we're going to school, not the year we're actually in, if that makes sense. So in 2018, we're going to file for the 2019 school year. So the prior from 2019 is 2017, which is technically one prior year from 2018. Clear as mud? That's the federal government for us. But the long story short is, you're on the clock when your student starts the second half of their sophomore year of high school. That's your base year. It's the January of their sophomore year of high school until the December of their junior year. And that's the snapshot, that's the tax year that the schools are going to look at. Now, when we're talking about the more generous schools, if there's been a change of income, if something's happened, you've lost your job, took a big pay cut, something like that, they can be talked into looking at other tax years depending on your situation. But generally speaking, your base year starts that sophomore through junior year of high school, and then will continue through sophomore/junior year of college, which is important, and we'll talk about that later. It helps us when we have other people helping out for the cost of college. If we have 529s or grandparents pitching in or aunts and uncles pitching in, it actually gives us more planning flexibility when the prior year happened, because we have 2 years of college they can help out with rather than just 1. All right, income, we just talked about that. It's based on your base year. You got parent assets, and then student income, student assets. The neat thing about parent assets is you get what's called an asset protection allowance. So the federal government says this is how much money you're allowed to have before we start assessing you toward paying for college. The asset protection allowance, here's a chart of it, unfortunately. In the 90s through the 2000s, it was ticking up a little bit. It's about $52,000. This is for a married couple with the older parent at 48 years of age. Your asset protection allowance was $52,000. It promptly plummeted to $18,000. Actually, the year this happened, it plummeted to like $7,800. But there was such outcry from the public that, oh, well, our bad, we didn't mean $7,800, we meant $19,000. It's ticked up a little bit. It's now around $24,000. 21 was last year's number. It's about $24,000. But that's how much money you're allowed to have before they start assessing you. We're saying, okay, you have plenty of money set aside. Now the rest goes to pay for college. Students don't get any asset protection allowance. So you get a $25,000 worth of net worth, and then beyond that, you got to start pitching in towards college. So what are these assets that are countable? It's cash, checking, savings accounts, investment accounts, after-tax investment accounts, so any stocks, bonds, mutual funds. If you're holding a mortgage, that counts. 529 accounts. 529 accounts count towards your assets, and all 529 accounts count towards assets. So you might have child number 1 entering college next year. We have to enter their 529 account balance, but we also have to enter the 529 account balances for the 2 other children you have at home and what's in their accounts. And yes, Floyd Prepaid is a 529 account, so that account counts, as part of your assets. And then student-owned assets and stuff will be counted as well. Trust accounts, they are great estate planning tools, but they don't remove things from the aid calculation. So what's not countable? Retirement accounts. Your IRA, your 401k, 403b, those accounts are off the table, off the radar. This is all for FAFSA. I'll bring back into profile for just a minute. Home equity doesn't count. Certain life insurance policies don't count. Family farm and family businesses. So it's a family business if you or your family owns a majority share and there's less than 101 employees. That's a family business. If you are, majority shareholder in Coca-Cola, you're, that's going to count. And you have to put that on your FAFSA. You probably don't have a problem paying for college if you're a majority shareholder in Coca-Cola, but you still have to report it. And those second three, I guess, the annuities, home equity, and life insurance, those are counted on the profile form. Annuities are counted 100%. Home equity is asked about. Life insurance can be asked about. There's a lot of people out there, schlepping life insurance saying, hey, it's off the radar, dump your money in here because it's going to protect things. That's true sometimes, and you have to have a very clear understanding of when it's true and when it's not, and if it can help you and if it can't help you before you dive into something like that. So we know what our EFC is. We got to calculate it through our FAFSA form or via the CSS profile. We know the cost of the school is. So we talked about that earlier. So how does this all come together? Well, the cost of the school, not tuition, but the entire COA, the entire cost of attendance. Take that number, you subtract your EFC, expected family contribution, and if there's any difference there, then that's your need. Okay? So the cost of attendance at University of Florida, we're going to take a typical family in Boca Raton, and their EFC is $25,000. Cost of attendance at University of Florida is $21,000. So you're expected to contribute more than school costs. There is no need for you at a $25,000 EFC. But at Duke University, with a cost of $70,000, you're expected to contribute $25,000, and so there's $45,000 worth of need there. We'll get into how that's met at different schools, but it's very important to know whether you're going to be whether you're going to be qualifying for any type of aid, and what type of aid you'll be qualifying for. And it doesn't matter, again, what neighborhood you live in, what your boss makes or the person that works for you makes, because every family situation is different. And frankly, I've had one family that might have two different calculations within the same family because they're looking at two different schools. I had a family that had twins 2 years ago, and the twins had totally different situations. One twin got need-based aid, one twin got absolutely no need-based aid because of the schools they went to. So it's very important to not just write this stuff off because you make a decent salary, because you have a significant amount of assets, until you truly know the situation. Speaking of assets, this is how they're looked at. So the FAFSA looks at parental assets above that asset protection allowance, and they're going to assess you about 5.64% of your assets above that. So just round figures, $100,000 worth of assets is going to be $5,600 and $5,640 worth of extra contribution, or $5,640 worth of aid not gained. The profile schools look at parental assets about the same. They're worth about 5%. In the student's name, they are 20%. Student assets are assessed at 20% for the FAFSA and 25% on the profile. There's a third methodology, consensus methodology. There's only a handful of schools, about 11 schools in the country that use that. They're very special, and it's a whole other conversation. One thing to note here is student 529 plans are assessed as parental assets, even if the student owns it. And that means that if your child has accumulated a significant amount of money and you would otherwise qualify for need-based aid, but they have this money that's going to throw them for a loop, depending on the situation, it may make sense to take that money and purchase a 529 within their custodial account. There's people that have done it. There's actually people in here that have done it. So it's a very neat tool that we can use. You have to do it properly. You have to understand the implications. You have to understand the tax implications of doing that. And I don't want people to just assume and go out and do it, because then your financial advisor gets mad at me because they did a bunch of unnecessary work. But it can work. It can work for certain families. So the question is, does this mean that all of our money, the family money, should be in a parent's name and not in the student's name? And the answer is very clear. It depends. It depends on the family situation. If you're an aid advantage family, then yeah, you want your money in the parent's name, within the legal confines of whether or not we can actually do that. If you've got a UTMA account, that's an account in your student's name, and you don't just pull money out of the account and stick it in your bank account. That's not how things work, and that's a bad idea. But long story short is, for certain families, if you're in what we call an aid advantage family, then the assets are better off in the parent's name. If you're what we call a tax advantage family, then no. The assets are better off in the student's name. If you're not going to get any need-based financial aid, you're actually better off with the assets in the student's name. We'll get into that in a couple minutes as to why that is the way it is. All right, so I talked about the different schools and how they meet need. The neat thing is we've got computer programs, and there's a bunch of information out there, and if you know how to aggregate it, we can determine what a school has done in the past. We have a powder puff tree in our backyard, and my daughter said she was going to miss me this evening, and so she plucked this thing off the powder puff. I just realized I'm walking around with this pink thing sticking out of my pocket. My 7-year-old clicked this and said, "Daddy, please wear this for me tonight." So that's my little pink powder puff. Little sidebar there, it just caught me out of the corner of my eye. Anyway, every school's got an award history. And with the information that's available to us, we can tell you very closely what type of discount your student should be able to receive at various schools. And it's very important to know what percentage of need that a school meets and how they meet that need. And we'll get into that in just a minute. But how they meet that need. So meeting 100%, actually there's in the folders you guys have, there's a list of the schools that meet 100% of demonstrated need. So that means that example I gave earlier, Duke, I'm sure they're on that list. Not I know Davidson, they're just down the street, is. $70,000 cost of attendance, $25,000 EFC means your demonstrated need is $45,000. The schools on that list will meet that full $45,000. Then the next question is, okay, but how do you meet that? How much of that is gift aid, and how much of that do we have to pay back? So there's only about 9 schools that will meet 100% demonstrated need with 100% loan-free. And those are, as you can guess, they're the most competitive schools out there. The Ivies, with the exception of Dartmouth, all do it. Dartmouth generally does it too, they just don't promise to do it. And then there's a number of other schools in there. But it's important to know how generous a school is, frankly, and how that works out for your particular family, because your family might be different than the family sitting next to you or the next house. So, and what types of aid are they likely to give? Are they likely to give merit aid, or what I call merit award? Merit award is free money. It's free in the sense that you don't have to pay it back. I put air quotes around it because there could be a stipulation, right? The quarterback that got recruited to play for the football team gets a full scholarship. He gets free money, but it's contingent on him playing football. Same goes for the softball player, the soccer player. And there could also be merit money that's academic, but it's contingent upon you keeping up a certain GPA, or contingent upon you participating in certain activities. So it's free money in the sense you don't have to pay it back, but there are often stipulations with with the continuation of that money year after year. Well, merit aid is by far the best way to go. And again, here in Florida, we have merit aid outside the schools. If you stay in the state of Florida and your child qualifies for it, we have Florida Bright Futures. That's merit money from the state of Florida. It's a great benefit. And then there's the need award. Grants are the best because they're free money. So scholarships are your free money on the merit side. Grants are your free money on the need side. And you've got things from the federal government like the Pell Grant. In Florida, we have, it's called EASE now. I forget what the acronym stands for. EASC. It used to be the FRAG, the Florida Resident Access Grant. But it's a grant to make private school more affordable, private college more affordable for state residents in the state of Florida. So it can be awarded by the school or the government. Then there's need-based money, which has strings attached. And that means you have to earn it. It could be work-study. It could be a student loan. That's why they say the strings attached, because it probably has to be paid back. And that comes back to the schools that aren't on that list, the 4,000 colleges that aren't on that list in the folder you guys have, are going to offer some type of aid package, and it's going to have some type of loan included in it. I mean, just expect it. Aid packages are going to include a student loan in their package. So it's important to know the discount and how they're going to give it, out. Oh, Beyond. Sorry, I actually forgot what happened next. So Beyond, okay. We understand our AFC. We understand the need calculation. What's beyond that? I said the fourth component after financial aid was taxing, right? So, buy a Tesla, you get a tax benefit, right? There's a $7,500 tax credit for buying a Tesla currently. And actually, just when I was doing my research for this presentation, I didn't realize this. If you're going to buy a Tesla, I'm not going to get into I see some head shaking. I'm not going to get into the politics of Elon Musk or what's going to happen to the company, or if the stock price should plummet. Very well may. Kind of has been. It's been all over the place, all over the board lately. But anyway, there's this tax credit, $7,500 tax credit for buying a Tesla right now. There's a few other cars that qualify for it as well, but I like the looks of the Tesla. That's going away. So if you're going to buy a Tesla, do it now, because the tax credit's going to go away. The law said after you sell $200,000 vehicles, the tax credit gets phased out. They just sold the $200,000 car in June. And actually, originally I was going to put the Model 3 up there, but if anybody has tried, I don't know, I don't have a Tesla, I just think it's an interesting company. Good luck getting a Model 3 on time. And you could actually have ordered one expecting the tax credit, and if you don't get it until 2019, the tax credit gets phased out. And I forget the numbers. I think it drops in half in the first half of the year, a quarter in the second half of the year, and by 2019 it's gone entirely. So we'll have to see what happens with that. But there's a tax credit. I'll come back to the Tesla and why I bring that up in a minute. But another version of tax aid is the tax credit from Uncle Sam called the American Opportunity Tax Credit. It's the most generous tax credit we've ever had for educational purposes. It's $2,500 per year per student. And it's a tax credit, which means it's a dollar-for-dollar reduction in your taxes owed. If you have a $2,500 tax bill and you qualify for the AOTC, you now have a $0 tax bill. The coolest thing is it's actually 40% refundable. And what that means is you could actually get to a 0% effective tax rate where you owe no federal income taxes, and they'll actually still give you $1,000 back. And I'm not talking about refunds here, people. I'm saying you literally paid nothing in federal income taxes, and they're going to send you a check back for $1,000 with the AOTC, assuming you qualify for the AOTC. Their lifetime learning credit's still out there, but we don't use it. That's for older students or students that have been in college for more than 4 years because the income limitations are lower and it's not as generous. But it is still out there for older students or people if you have a kid that dropped out and is coming back, or you're going back as an adult, the lifetime learning credit is still available. The downside with the OTC is if you make too much money, you're phased out. So over $90,000 as a single person, you lose the OTC. Over $180,000 as a married couple, you lose that. So what do you need to know? What's a qualified expense for a tax credit, like the AOTC, is different than what's a qualified expense for your 529 plan. So qualified expense for the tax credit is tuition and fees. There's a little, it says up there, it also includes expenses, necessary expenses for the class. But the reality is tuition and fees are what count for a tax credit. Room, board, incidentals, those can all be paid out of a 529 account, and they're considered qualified expenses, but they're not qualified expenses as far as the IRS is concerned. So the one kicker here is it may not apply to a lot of students that have prepaid 529 plans. If you have Florida prepaid, that's paying your tuition and fee expenses, or the majority of them. So you may not qualify for the AOTC. I've been working since April on this very diligently. I've got 5 different accounts I'm working with. I think I have something in the works for 2019, but as it stands today, it's something to understand is how all these different pieces fit together, and that's kind of where the comprehensive part is. I've got this 4-part process, but there's no one part that is more important than the others. It's understanding how the 4 parts come together. So here's a couple tax tips you need to know. I just said, use your 529 plans for your room and your board and incidentals. Pay out of pocket if you can. This is one of the strategies we use, is you pay out of pocket for your tuition fees. Because then you can qualify for the tax credit, and then you take your 529 distribution and pay for the room and board expenses. The way the OTC works is you get 50% of the first $2,000 worth of expenses and 25% worth of the second $2,000 worth of expenses. So what that means is you need $2,000 of tuition and fees paid out to qualify for the maximum AOTC. If you're using lifetime learning credit, it's only 20% credit, so you need to pay $10,000 out in tuition and fees. This is a lot. I'm throwing a lot of stuff out at you. I apologize. We'll have time for questions at the end. Okay, so fantastic, right? There's tax credit out there. What if you're not eligible for any need-based financial aid? And you know this with 100% certainty because you've spoken to me, you've spoken to someone at Milestone, and you know without a doubt that you will not be eligible for any need-based financial aid at the schools you're looking at. And you make too much money for the AOTC. You're phased out of the AOTC. But then, that's when you need to come see me. But what we do is called tax advantage planning. And when I say tax advantage planning, I'm talking about shifting income or assets from the parents to the student, combining education tax incentives with income tax strategies within the constraints of the gift tax limits, kiddie tax rules, and the student's tax capacity. That sounds like a mouthful. It is. That's why I read it every time instead of trying to say it by heart. And this is when you need to engage a professional that knows what they're doing. What that looks like, we'll get into this in a second. Sorry, there's a red line there. I don't know if you guys can see it, but the kiddie tax. The first thing we get run up against when we're doing this is the kiddie tax. And I've actually run into some or proposed this strategy for some clients, and they run it over to their accountant and says, "Oh, the kiddie tax, the kiddie tax." And when I was looking for a picture for the kiddie tax. I actually stumbled across this one. This was some accounting firm put this out last year. So the kiddie tax changed this year for the first time in a long time with the new tax code that we're all under. But this says, why the kiddie tax is more dangerous than ever. Dangerous is a strong word, but you need to understand how it works. You need to understand what's happening there. But the kiddie tax applies to all children under the age of 19. And then it also applies to all full-time college students under the age of 24. And then the red says unless they just provide half their support, with earned income. We'll get into that later. The change, that first bullet point has been the same for a number of years now. It includes, kiddie tax used to end when a student was the age of maturity. Now if you're in college, you're still considered kiddie for the kiddie tax purposes. In 2018, the first $2,100 is not taxed, but now it used to be, the way the kiddie tax used to work is wealthy families would shift money to their children to pay lower taxes. The government got wise, and they said, no, listen, now you're going to pay the parents' tax rate. Well, with this new tax code, you don't pay your parents' tax rate, you pay at the trust tax rates. Depending on how much money the parents are making and how much they're worth, the trust tax rates are generally, they ramp up faster. So what that means is you could have a student paying more in taxes under the kiddie tax than their parents would have paid. So again, it comes back to where the assets make the most sense and moving around. Don't just go shifting something in your kid's name without talking to me, because I don't want any financial advisors or accountants calling in and yelling at me, what did you tell them? This is a generic presentation. Don't take anything to the bank just yet. But it's one of those things that we have to be aware of when we're looking at these tax advantage strategies. One of my favorite ones is, and this is a real family here in Boca. This slide's actually a couple years old. She's now, the oldest has graduated early. She's actually now working. But when they instituted this income strategy, the father was a business owner. He was making a great income. He didn't qualify for any tax credits. And the problem is, besides the tax credits, there's also child tax credits. That once you're making a certain amount of money, you don't get those either. So these families that are making really good money, they're getting squeezed from all sides. They're paying tons of money in income taxes. They're paying tons of money. They expect to pay tons of money from the colleges because there's no need-based aid out there. So anyway, we did an income shift. We had him shift income to his daughter. She went to work for him on payroll. And by doing that, we eliminated about $11,000 worth of income taxes on the father's side. Now, because of the way he had the business titled, he was actually not paying any payroll taxes on himself because he maxed out his FICA earnings and then was doing a dividend out to himself. But anyway, he wasn't paying any payroll taxes. By bringing his daughter to the company, he had to pay payroll taxes for her. But by doing this, she earned all of her income, which means she was not subject to the kiddie tax. So she was able to qualify for her own standard deduction, her own personal exemption, and her own American Opportunity Tax Credit, which the parents were long since phased out. And because she wasn't subject to the kiddie tax, she was one of those people that qualified for that $1,000 rebate. So we were able to entirely wipe out all of her federal income taxes and give her a check back. So yeah, Dad had to pay $4,000 in payroll taxes, but the check back for $1,000 helped offset that. So the net difference was about $8,100 per year for the daughter. Now she screwed up my whole plan because she graduated early. So we only get to save $24,000 by doing this instead of the $32,000 I had presented to the family. But there's worse problems to have. And now second daughter's in college, and we're doing the same thing there. So it's a very fun strategy that we can put in place. But again, this works only if you are 100% certain that you're not going to qualify for any need-based aid. Because if you do, the parents have an income protection allowance. Students have an income protection allowance, but it's a fraction of what the parents is. And if you do this, you're going to totally upset the apple cart for any need-based money. So back to the Tesla. Why the tax credit? So, got a call from Joe. He's an attorney up in Orlando. And if you follow the Tesla stock, it's been all over the board lately. But this was a few years back, and he had bought this little electric car company. Stock in this little electric car company was like $25 a share. And it had gone up, and it was like $180 a share. And then it was $220 a share. And he called me up, and he's so excited. He's like, Sean, this is awesome, but I'm going to get crushed on capital gains taxes because of how much money he was making. If he were to sell the stock, he's going to pay through those for capital gains taxes. So we put a asset shifting strategy into play for him. And instead of, if he had sold the stock, he would have realized $28,000 worth of capital gains. And he's at the top tax bracket, so it's a 20% capital gains rate. On top of that, once you earn a certain amount of money, then you get hit with this surcharge, this 3.8% Obamacare ACA, Affordable Care Act surcharge, once you cross over certain thresholds. It's one of the things, I don't get political up here, it's one of the things, Trump beat on the how bad Obamacare was, yada, yada, yada. They did this major tax code revamp this past year. They left in the Obamacare surtax in there. So, unfortunately, even with the tax code, parents are still subject to it. So, yeah, basically, long story short is 20 plus 3.8, you got 24% capital gains for the parents. By shifting it to the daughter, doing it the right way, and flowing those assets through her, she was able to realize a 0% capital gains rate. Again, her income's not high enough because she only had basically $28,000 worth of realized income. She was not subject to the Obamacare surtax. Long story short, it would have cost Dad 24 cents of every dollar worth of stock to sell. We were able to shift to the daughter, and it cost her $0. Every dollar of stock she sold, she got to keep. So again, savings there, $5,300 per year per student. And this was back when Tesla was like $220 a share. It's since gone way up into the high threes. I don't know where it's at today. It's in the mid twos. It's still worth more than what they sold it for, and we've been able to do this year after year, year after year. So it's not always possible, but especially with where we're at in today's stock market, we've had a really great run. We all remember the crash of 2008, but since then we've been on a tear, and there's a lot of families out there that have highly appreciated assets. And before you go liquidating them, talk to me or ask me if something has to happen, because the last thing I want to see you do is pay 15, 20, 24 cents to Uncle Sam if that's not necessary. All right. I don't know where we're at. R for resources. So we covered the college selection, right? Finding the right school for the right reasons, financial aid, need-based and merit-based, and then tax aid. The final part is pulling it all together. These are your personal resources. And personal resources are going to be different for everybody. Here in Florida, I mentioned a few times, one of the resources many of you may have in here is going to be the Bright Futures program. So Bright Futures started off with a bang years ago and covered about 100% of tuition. It all had dwindled over the years. Up until like 2 years ago, it was covering the top tier. There's two tiers, the FAS, the Florida Academic Scholars, and the Florida Medallion Scholars. And the FAS, the top tier, was covering about $3,300 a year at a state school, which worked out to be about half of the cost of tuition at a Florida State, or FAU, or something like that. A couple of years ago, they got it through the budget. It was last year. It was 2016, they got it through the budget. They said, okay, top tier, we're going to pay 100% tuition, which was great. But they got it through the budget, they didn't get into law. And I actually stood up here last year and said, listen, this is the year it's going to happen. Because it's 2018, it's an election year, people want to get an education, they're going to get it into law. So they got it into law, and it was better than we had before. The top tier, they kept it at 100% of tuition. There's a $300 per semester, or $600 per year book stipend. And actually the top tier are now paying for summer classes as well. The second tier, the Florida Medallion Scholars, when they got it through the budget 2 years ago, kind of got left alone. They didn't increase the award for it at all. It was still about $77 per credit hour. Is that correct math? $77 per credit hour. And they didn't increase it. When they stuck it in a law this year, that got a big bump. It is now 75% of tuition and fees. And right now, if you've got students in college right now, it hasn't picked up any summer classes, but that's going to be starting in this coming summer. So summer 2019, the Medallion Scholars are going to have summer classes paid for as well, at 75%. So just the Medallion Scholars, most people know about this one because this happened a year ago, and a lot of families have been talking about it and what have you. Medallion Scholars is the big news this year. And last year, I actually have a client called me. His daughter's at Florida State, and he sent me the financials here. And Sean, is there anything we should do? He's going through a divorce. Is there anything we need to do? Yada yada yada. And I said, guess what? You're gonna get a discount this year. He said, what are you talking about? He said, Florida prepaid. She had gotten the second tier. Last year, the Florida Medallion Scholars paid $77 per credit hour. This year, it's 75% whatever that school costs, but it works out to be $158 per credit hour, $159 depending on the institution. So this is last year. They gave you 77 per hour. This year it's 158. It's more than double the benefit that they saw last year. So it's something to know about, and it's a reason I harp on families for SAT prep, ACT prep, because that's what I see holding parents back. I don't do it, but the good news is I know a great group that does, and so if you're even close, to me it's money well spent, because that's a resource we all have. Now the downside is, the positive thing about Bright Futures, it can be used anywhere in the state of Florida. The downside is if you go out of state, then you don't get it. You have to be here in state. Something I'll mention while I'm thinking about Bright Futures. Everybody, I don't use absolutes very often. So when I say everybody, I mean everybody that qualifies for it has to apply for it. Okay? I don't care where your child is going to university. If they're going to MIT or Stanford or University of Alaska, they have to apply for Florida Bright Futures. Okay? Because we never know what's going to happen. I can't tell you how many families I've seen go to Brandeis and it didn't work out, and they came back. Or they went to University of Iowa, and something changed. I had a student that didn't listen to me, and she went to run track at a school in Pennsylvania, didn't like it, didn't have her major, came back here. They did not apply for Bright Futures, and when she came back to Florida, she didn't have it, and she would have had it if she had come back. So if you apply for it, even if you don't use it, just putting it in the application after you graduate from high school gives you a year grace period. And then, actually, double check. I have to double check myself. It's definitely at least a year. It might be 2. Is it 2 years? It's a 2-year grace period. And if you come back and take a class, you use your Bright Futures as an enrolled student in a Florida university, that 2-year window becomes 5 years. So it's very important to understand that, yes, your student may be going away, and we hope they never come back to Florida, or they don't come back to Florida to finish college, but they might. And it's ridiculous, frankly, to leave $7,000 per year off the table because you didn't feel like filling out this online application that takes 4 minutes to do. Okay? I'll get off my soapbox for a second. Everybody has to file for their Bright Futures if they qualify for it. One other thing, not on a soapbox, but one other thing about Bright Futures. I had a daughter, or a client. The daughter is just matriculated at Tulane. And she said, well, she's going to come back this summer to help save some money. She's going to come back this summer and pay and use her Bright Futures to do summer classes here in Florida. It's a good idea, and it can work well. But one thing you have to understand, and I've actually spoken with the higher-ups at Bright Futures, if you are a transient student, it doesn't work. You have to actually be an enrolled student. So if you want to come back from Tulane or whatever school you're at, in her case Tulane, if she wants to come back from Tulane and take classes at FAU or Palm Beach State, if she does as a transient student, they look at her as a Tulane student and she doesn't qualify for her Bright Futures. If she actually goes through the process of applying to FAU, becoming accepted to FAU, then she'll become an FAU student and can use her Bright Futures and then extend her window out to 5 years. Okay? There's a lot of moving parts again, but that's why you've got professionals that know what they're doing and keep on top of these things to know what's going on. Florida prepaid. A lot of families have it. It's a tremendous benefit. Depending on which plan you have, will determine how much they're going to pay or how much they're going to cover towards your cost of college. There's one of the most popular plans is what they call the 4-year, the 4U. It's a 4-year university plan, which is 4 years of university tuition. For most families in here, you're going to have bought your plan prior to 2007. And that's important because there's 3 different windows in time that you could have bought your Florida prepaid. Prior to 2007, from 2007 to 2011, or then the most recent window. If you bought it prior to 2007, when you look at the cost of Florida State University, there is the tuition bill, and then there's what's called a tuition differential fee, which is the college's way of getting around the state put caps on tuition. So the schools want to increase their prices, so they threw this new fee on top. If you bought your plan prior to 2007, you are exempt from the tuition differential fee. So it's $45 per credit hour that you save if you use your Bright Futures. If you use your prepaid plan in the state of Florida. That's if you bought it prior to 2007. If you bought it after 2011, the fees are rolled into your plan. You basically pay those fees when you bought your plan. There's a window there from 07 to 11 that you neither bought those fees without realizing it, nor are you exempt from it. So you're stuck in that window where you're going to pay. If you, they're only going to give you $117 is the long and short of it. It's towards your tuition, whereas if you were pre-07, they'd give you more like $160 something. towards your tuition. But the important point here is do not cash it in, okay? I don't care if you get Bright Futures. I don't care if you get a full scholarship. I don't care if you're going out of state. Do not cash your Florida prepaid in. There's a lot of better options than that. If you go out of state, it can be used out of state. And what they'll do is they'll pay the rate they would have paid to the state university. And those rates are kind of what I have up here. These are last year's rates. So, you go to your doctor and the bill's $9,000 because he looked at your pinky. And then your insurance company, sorry, no offense, saying doctors in here. Your insurance company says, no, we have a negotiated rate. Our negotiated rate is $87 and that's what we pay. So the cost of tuition and fees at a state university right now is about $211 per credit hour. Florida Prepaid's negotiated rates are around $200 per credit hour. It's $199 on one. Depending on which plan you have, if you go out of state, they'll pay what they would have paid to the University of Florida or FAU or whatever to your out of state school. So it's not going to be as valuable there, especially if you're pre-07, because you don't get the credit for that tuition differential fee, but it's still going to be worth a lot more than if you just cash it in. If you don't need it because your child gets a full scholarship. I had students at Florida Polytechnic in Lakeland. The first class of Florida Polytech, everybody got free tuition for their first class. And I guess they just graduated last year, 2 years ago. Anyway, long story short is, if you didn't need it because you got full tuition, you can do what's called a tuition, or you got a full scholarship, you can do what's called a scholarship reimbursement. So they will pay you, the parent, what they would have paid out to the school. And the reason this is important is if you had this plan, if you had if you had all the fees added on, you had the maximum fee plan, they'd be paying out to the school $199 per hour on your behalf. You might have bought this thing years ago, and you bought it when prices were $50 per hour. So if you cash it in, you get back those $50 per hour that you paid. But if you paid a quarter of what this thing is worth today, that's what you get back. Not a penny in interest, not a penny in earnings, and if you paid any kind of enrollment fee, you don't get that either. So you get exactly what you paid less your enrollment fee. If you use it at another school, or if you do a scholarship reimbursement, they'll pay to you what they would have paid to the university. So it's a more efficient use of your money. And the other thing too is, if your child goes out of state or goes to a private school, and you are certain they're coming back to Florida for graduate school, it can also be applied to graduate school, and the same rules apply. If you go out of state, you go private, or you go to graduate school, they would pay the negotiated rate, that they would have paid. So if you go out of state or private, they pay the average rate, and if you go to graduate school in state, they pay the actual undergraduate rates for that college. They pay University of Florida, they'll pay towards graduate school the undergraduate rate at University of Florida. Make sense? Long story short, don't cash it in. And actually, we've got a family at UM right now, at University of Michigan, and I said, basically, long story short, don't do anything right now. Because another option you have if you go out of state, so just for argument's sake, you have this plan, they're going to pay $200 per hour, and you're at University of Michigan is $1,000 per credit hour. You can actually roll it up, and they'll pay the full $1,000 per credit hour. The problem is, you're going to burn through this 5 times as fast. As there's 2 options. You can have them pay the $199 per hour, and you're going to make a big difference. Or you can roll it up, and they'll just burn through it 5 times faster. So you could literally burn through 4 years of tuition in less than a year. So if you're out of state and you can afford it, I actually have families do nothing because we don't know if they're going to come back. We don't know if they're going to be in state, and we always can. Not always, but usually, if you're out of state, you can burn through it faster than you would have burned through in Florida. So, long story short, don't cash it. Call me, call somebody at Milestone, and we'll tell you the best plan to do. Because cashing in's, I've never yet seen that being the best option. The other thing too is you can actually pass it on to other students. So if you bought it for one child and they didn't need it, you can then pass it to a sibling, even a cousin if you want. Okay, college savings. I'm going to go back to this real quick. The way I view this is a hierarchy. When it comes time to use your resources to pay for college, this is the order I would prefer to have to see it done. Use your Bright Futures or your grant money, your merit or your grant money first. Then you go to your prepaid plan. Then you go to your college savings plan. That's when you tap into your 529 savings. If you've got UTMA or UGMA accounts in the kids' names, and it was earmarked for college, that's when you tap into those accounts. If you've got, again, if there's specific accounts earmarked for college, this is when you tap into it. You use your Bright Futures first, then you use your prepaid, then you use your 529s, then you use your other college earmark savings plans. All right? Then we talk to grandma and grandpa. They're going to help pitch in. This is when they would come into play. So we're going to go through. They're the next step. Grandma and grandpa, or any family member, anybody really, can help pay for college. Most likely, it's going to be the grandparents. They can make payments directly to the school. The neat thing about doing that is there's no gift tax implications there. So we talked about gifting money and whatnot. If there's a gift tax threshold of $15,000 per person this year, if the grandparent or the benefactor writes the check directly to the college, there is no gift tax implication. They can write a check for $50,000 and they don't have to worry about the gift taxes. I don't like doing that because of the different tax strategies and stuff that we generally can put in place, but that is an option. They can gift money to the student directly or to the parents directly. Again, you have to be very cautious when doing that because depending on when that money is gifted and where it's sitting, when we go to file the FAFSA or go to file the profile, that could kind of upset the apple cart when it comes to any need-based aid that could be out there. So you have to understand the timing of that. And then grandparent 529s. When they switched the financial aid code, the prior year, it opened this grandparent 529 opened the window for us tremendously. I used to say that grandparent 529s only had to be used for the senior year of college because it could mess up any other aid because of calculation. Now that they're looking 2 years back, grandmother, grandfather can actually use their own 529 plans to help pay for the junior and the senior years of college. The reason that's important is a grandparent 529 is off the radar when it comes to filing your financial aid forms. Right? When you file your FAFSA, grandparent 529s don't count. Profile, some schools will ask a little bit something, but for the most part, grandparent 529s don't count for an asset when you're filing the forms. The problem is distributions out of those grandparent 529s get counted as student income. And student income is assessed at 50%. So if you had $10,000 worth of need, and grandma and grandpa sent $5,000 out of their 529, you just had $5,000 worth of income, and you just reduced your need by $2,500, like by half of whatever the distribution was. So 529 plans held outside of the immediate family can be very beneficial, but you need to know when to use them, and when to use them is the last 2 years of college. Okay? And then the final step is parents, students, your income, your cash flow, and just writing a check for it if you can. Again, if you can write a check for it, but you get Bright Futures, you use Bright Futures first, and then you use your prepaid, then you go through the steps. So I like using student income first, because I think my personal opinion is a student should be contributing to this situation that we're all in, and at 18 years of age, if they're making some money, that can go toward helping to offset the cost of college. And it doesn't necessarily have to be tuition, but they can cover their own car insurance or cell phone bill or spring break excursions, a Europe trip, or what have you. But I think the students should have some skin in the game, and so I want them to use their income first. Because the reality is, none of us are getting younger in this room. Certainly haven't since I started talking. And at 40, 45, 50, 55 years of age, you have less time to make up for the money that you're spending today. Whereas your student at 18 and 19 and 20 years of age, we can burn through their income because they've got a whole lifetime of earnings ahead of them. Those of us are there on the backside of our careers. I want to see it come from the students first. So, income and assets to be used, I generally prefer the student first, parents second. Then finally, and last, is loans. I'm generally against loans. Obviously, the reality of life is a lot of families will need to take them. If you need to take them, the one you want to always take first is a Stafford loan. Stafford loan is a loan, it's in the student's name. There's no credit qualification. You have to be alive, have a social security number, be enrolled in college. Congratulations, you get debt. But it's in the student's name, and it will always be in the student's name. It also has the best interest rate you're going to find on a student loan. This year's interest rate is 5.05. Last year was 4.6. We are seeing them tick up a little bit as interest rates are increasing. It was 5.05 this year. Payments are deferred while you're in college, and then there's the standard repayment plan is a 10-year repayment plan. The rub with the Stafford loans are the thresholds. So if you're a freshman, they're going to give you $5,500. If you're a sophomore, they're going to give you $6,500. And then the final 2 years, they'll give you $7,500. The problem is, a lot of families need more than that. But I just want to start here. It's going to be the best interest rate. It's going to be in the student's name. I said I'm generally against loans. I am, frankly, I like using the Stafford loans for some of my wealthier clients. And I like that because a lot of the kids, especially if you're in a more affluent area, as we are, if you're in a more affluent family, a lot of these kids have been to fancy schools or they've been surrounded by free stuff, right? They got their first iPhone when they were 8 or 10 or 12, and they got the car given to them when they were 16, and then things have just been taken care of for them, and everything's just been given. And I'm a big fan of mom and dad setting some ground rules. And hey, you're going to take this student loan, and this is going to be on you. And if you graduate on time, if you follow our rules, right? Our rules might be you don't get kicked out of school, or you graduate on time, or you have a certain GPA. You set the parameters as a parent, and if you do these things and you graduate on time, you follow whatever the stipulations are, then we'll write the check and we'll pay this off the day you graduate. But if you don't, then this is on you, and this will be your cross to bear, your burden, going forward. So I'm not totally against them for that. And when we're putting that into a plan, we understand that there's going to be a cost for doing it. I mean, there's going to be some interest cost and whatever. But I do think for some families it makes sense to have these a little dose of reality for some of the kids that have not had much reality in their upbringing. So we've got the income thresholds, not the income thresholds, I'm sorry. The loan limits of the Stafford loans. If you need to go beyond that, then you get into the Parent Plus loans. And the Parent Plus loans are exactly what they sound like. They're given to the parents, and they are in the parent's name. And they will always be in the parent's name. You don't take a lot of parents say, oh, well, yes, I'll do this now, but then when they graduate, I'll transfer it to my student. And that's not how it works. You can't just pass off your Parent Plus loan that you signed for onto the student. It's in the parent's name. There is credit qualifications. So it's not nearly as stringent as buying a house or probably leasing or financing a car. But if you have adverse situations, bankruptcy or foreclosure or something in the recent past, you might be rejected. And if you get rejected, then they'll actually increase those Stafford thresholds for your student. They're going to get about another $3,000 per year that they can borrow. Might still not be enough. The benefit of Parent Plus loan is that you can borrow all the way up to your full EFC, or EFC less any money they've given you. So if you're going to Duke and it's $70,000 a year and they gave you a $2,000 scholarship, you can borrow the other $68,000 per year. I would not recommend that for anybody in this room because again, we're 40, 45, 50, 55 in here, and borrowing $60,000, any amount is probably not a good idea, but that amount is an absurd amount because the problem is that just got you through year one. And interest rates are rising. And right now, the current interest rate for the Parent Plus loans is 7.6. Last year was 7.0. Next year, the way things are ticking up, right, where the Federal Reserve keeps saying quarter point every few months, we're going to see a higher interest rate next year. And we don't know where it's going to stop. I mean, they're capped. But the reality of it is, this is in the parent's name, will always be in the parent's name. It's the next best. It's the next best loan, but it's not a good loan. And then the next step beyond that would be your private loans. And private loans are your Sallie Mae's or your Discover loans or what have you. They're going to be even more stringent from a credit qualification standpoint. Generally, they're going to be more expensive. And the way I explain to families in my office is that if you stop paying on your car, what happens? They come and take it from you, right? You stop paying on your house, you're going to get foreclosed on. You stop paying on your student loans, they can't take the classes back, right? They can't take that knowledge back or those parties back. So, it's not a good credit risk. And especially if you have an 18-year-old student, I hear that from parents. Well, we're not going to do the Parent Plus loan. We're going to let Bobby or Susie take a loan in their name. You've got an 18-year-old student, or child, however you refer to them. You've got an 18-year-old with no credit history, or very limited credit history, no income, and it's an unsecured loan. What bank is going to give this child $50,000 per year? So the reality is parents are going to be on the hook in the private world just as much as it would be on the Plus loans because you're going to end up co-signing. Is the best case scenario. Worst case scenario, you end up taking it in your name. So the Plus loan's probably going to, the best private loan I've seen is for the family I advised, and they did what they decided, but I think she was about 8.9% was her private student loan rate, which actually is not bad. But, I mean, think about if you went and bought a car right now. I don't even know what mortgages are at right now. They were under 4. They're probably now 4.25, 4.5. Compare that to 9% on a student loan, and we don't know what it's going to be next year, but it's probably going to be higher than that. It's not the best use of your money. So, you guys can take your goggles off. That's my world. Before we leave,